Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Thursday morning. We've got the man, myth, the legend back with us, Mr. Jonathan Twombly. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing well, man. It's been a couple of weeks. I kind of feel lonely on Thursday mornings. So thank you for coming back. Is everybody feeling okay?
Yeah, I mean, we were in Ireland for a week, and then which was great. And then last week we had some medical stuff to deal with, so I couldn't make it. So glad to be back. And yeah, and I'm feeling kind of embarrassed by how messy my office looks behind me while you have this like cool purple background going on back there. So
dude, I got lights, man. I got lights.
I know. Oh my goodness, look at that.
I can change them. Looks like you like blue, so we'll go blue today.
Dude, I gotta up my game. This is ridiculous. So right.
That's fun. That's fun. Well, hey, since you've been gone, I think it's pretty clear that we are heading for a recession. I mean, there's so many indicators that we would talk about over the last 40 years that say it's coming. There's the yield curve going flat. It's now down to, I think, 20 basis points. And I think it's going lower this morning based on what I've seen the 10-year doing. We've have the Fed coming out and saying they're raising rates, which historically has led eventually to a recession. We've got the outbreak of war. We've got inflation at 7 points. I mean, it's just all kinds of stuff, Jonathan. So what is an average person to do if they think a recession is coming?
Well, I mean, I would say do what I've been telling people to do for a long time, because we have been talking about this for some time, just by going, before I answer the question, sort of going back a couple of years, we were talking about the possibility of recession even before COVID.
We did,
there's a really good, there is some analysis that suggests that we were headed into a recession at the end of 2019.
Agreed.
And then COVID just sort of like blew everything up.
Yeah.
And like disrupted the whole business cycle. And we did have a recession, but it was COVID related. It wasn't business cycle related. It was sort of artificial, but that kind of like undid what was, or masked what was happening. Let's say mask is probably a better word. Mask what was happening in the real economy, right?
Unintended, I'm sure.
Oh yeah, actually, that's a good pun that I didn't actually think of. So
well, there you go.
Yeah. So anyway, so eventually you pay the piper, right? And we've been kind of skirting around this issue for a long time, but my advice has not changed from a couple of years ago. And that advice is get yourself liquid, right? Yeah. I mean, you want to have cash on hand for what? For the immediate purpose of like, well, if you lose your job or whatever, you got to have some savings to be able to fall back on and get you through it. But if you're fortunate enough not to be in a position where you're going to be economically impacted by a recession, you want to have some cash to take advantage of the buying opportunities that are going to come, right? And if there is a real recession, those buying opportunities will absolutely come, whether it's in the form of outright distress for real estate properties and other assets, or just the market slowing down because a lot of people pull back because they're nervous. And that will just, even if prices don't come down necessarily, it'll just make it a lot easier for you to get your hands on good assets. And as Warren Buffett has said, I'm paraphrasing here, but like times of economic distress can allow you to buy great assets at good prices, and good assets at great prices.
Yes.
Right. So it is an opportunity. And if you are not ready for it, you will miss out. The thing is too, during a recession, banks are going to get skittish, right? Banks always are pro-cyclical, right? Which means that they don't think like investors. They don't say, hey, let's lend, when at the bottom of the market, when asset prices are rock bottom and we're going to really be protected. They're saying, oh, we're scared, we can't lend now. And then, but they're happy to lend at the top of the market when they're taking the most risk. So banks will be out, which means that those people who have cash are going to benefit. And it doesn't necessarily mean that you have to buy assets in 100% cash. But if
No,
you're in a position to go to a bank and say, hey, we want to go in at 50% leverage, then a bank is going to be a lot more comfortable in that environment to lend to you, right? So because they're very well secured in that asset. So cash really becomes king in a recession, and it is a great, great opportunity to to pick up assets that are attractive for a great valuation. The other thing too, from a pure multifamily perspective, I would say if you're still buying right now, you really, I mean, I'm not a big fan of C properties in general, but the reason I'm not a fan of them is because of what happens in a recession, right? And there's this whole school of thought out there, which is based only in bad reasoning. There is no basis in fact. There is no evidence to support it. In fact, the evidence, if you go look at vacancy rates, and if you go talk with, say, management companies who've been in the business for a long time, they will tell you the exact opposite of like this story that gets sold all the time, which is that, oh, if there's a recession, people are going to live in a cheaper house, so buy C properties, right? They're gonna move down. What I'm here to tell you is that this doesn't happen, or it doesn't happen in a significant enough way to bail you out of the bigger problem. The bigger problem is that the people who lose their jobs in recessions are disproportionately your C renters, right? Those are the people who have the retail jobs, the service jobs, the jobs that, the big wigs at companies cut first, right? And so those are the people who lose their jobs and can't pay you rent. The people who are higher up than that, and the higher up you go, the less likely you are to lose your job, right? So first of all, those people are not having to move down, right? Because they're just continuing to get paid. I mean, if you look at the Great Recession, the unemployment rate for people with college degrees was like 3% at the height of the Great Recession.
At the peak,
At the peak, right? And using four-year college degree as a proxy for like, white collar jobs, right? Sure. It's not an exact one-to-one, but I mean, just it's a rough approximation,
it's a variable, that we can look at.
Which is a helpful proxy to look at, right? If you look at that class of renters, they're going to pay their rents, right? They're not going to have to move. There may be some people at the margins who decide to go cheaper, but think about like psychologically too. If you are someone who like you see yourself as belonging to a certain status, right? You are not you're not going to go, first of all, even if you can get out of your current lease, right? You may be in a lease already, right, for the next 8 months, and you can't leave anyway, right? By which time everything may have changed. The recession may be over. You may have gotten a new job, whatever the case is. You're on the hook for that lease rent, and that landlord is going to come after you for that rent if you leave. Believe me,
for sure.
Right? So, because if they can't find another renter, right, because it's a recession, well, you owe them the money. So you're not leaving that apartment, right, and to go find a cheaper place. So there might be some small number of people who have like their lease ends at the right time, they can move, and they're willing to take a step down in status and move to a less prestigious, less attractive, potentially more dangerous like part of the world. If you've got kids in school, you are not moving, right? You are not moving unless like, though there's a place next door that's in the school district that's cheaper, right? So this whole idea, and then on top of it, there is the actual stats you can go look at with the U.S. Census Bureau, like that actually show you during recessions, like vacancy goes up, it gets hit harder at, there's a lot of mythology also that grew up around the great financial crisis when we had the foreclosure crisis and people left their houses and went to rent. This is not a repeatable thing. This is not like, you will not have people walking away from their houses en masse the way they did after the Great Recession, not during the recession, mind you. It actually was during the recovery.
Exactly.
When people's mortgages reset and all this kind of stuff happened, right, that they walked away. So it wasn't even during the recession, right? So my advice to you, this is a rant, obviously, but my advice to you is like, if you're buying now, right, especially now, do not buy low quality properties. You want to buy the highest quality properties you can with the strongest tenant base you possibly can, with the view of riding it out. Now, there is a time to buy C properties, and that time is during the recession or right after, when everybody is scared. You can buy them really cheap, and you can buy them at like a really high cap rate, like a 10 or a 12 cap,
Yeah.
right? And build in a ton of safety, margin of safety, right? But if you're buying C properties at like a 4 cap, which people are doing right now, you've got no margin of safety at all,
Yeah.
right? And basically, if your occupancy goes, well, not even your occupancy will stay the same. You'll just get a bunch of people who are not paying you rent.
Yeah, it's the collection. Exactly. Yeah.
Your collections go down by a couple of percentage points. You're going to be in a world of hurt if you're buying at a 4 cap, right? So buy the highest quality you can, buy low quality at the bottom of the market, never at the top, right? And that's the way you do it. So that's how you prepare. Get cash, and if you feel the need to buy now, buy the highest quality you can, because you want to be able to ride it out. That's the key. The key is getting through it, right?
Yeah.
The key is getting through the recession.
Yeah, the key is getting through. Also, I would, again, I'm seeing so many mistakes right now that repeat or rhyme with the residential crisis. And that's the bad debt structures and horrible assumptions. I'm seeing them. And back to your kind of rant, I sold some C-class properties in 19, obviously pre-pandemic, at just ridiculous cap rates. One of them's already retraded, and that buyer/seller made some money, but it was only because rates went down and they got lucky.
Yeah.
And I have bought C-class properties at the bottom of a market for ridiculous prices. So I totally agree. I think you can do some great things, but it's near the bottom, not the top. Upgrade your class. And again, there's nothing wrong with raise cash. Right? Cash is an option on the future. And here's the deal. When the stress happens and banks get nervous, suddenly it's not 70% LTV, it's 60. And it's not 60, it's 50. And oh, by the way, I've been able to organize deals where I actually had to put 0 down, but I escrowed repairs, right? There's all kinds of creative things you could do if you have cash. People don't realize it. Banks were most nervous in 2010 when I was buying houses for 50 grand. It was crazy.
And I want to talk too about something else, which is like inflation and a recession and stuff like that. So people have there's this latent cultural memory of stagflation from the 70s. Right?
Sure. Absolutely.
And there were some recessions. There was a big recession from the oil shock in the early 70s, and there was a recession
73. Yeah.
Yeah, and then there was a recession in the early 80s, right?
81, 82, yep.
Right. But during stagflation, there was no recession.
No, right? You have growth.
Right? You have growth.
It's just really little.
Right. Yeah, but the thing is, you had growth, but there was no recession, right?
Correct. Yeah.
But it was bad and people didn't like it and they felt unhappy, and they were sandwiched in between 2 actual real recessions. Like the whole period, and there was other stuff. Lost a war in Vietnam. Like there was all this kind of stuff going on that made people feel really crappy.
Yeah, the 70s were no fun,
except for disco, right? So
you like
disco was fun. Well, no, I mean, I remember being forced to wear bell bottoms, and I because that was what was available. And I just remember in the 90s when like people younger than me were wearing bell bottoms. I was like, you guys weren't forced to wear those as kids. You don't have this trauma that I have of having to, why would you voluntarily wear those things? But anyway, but we're not talking about, if you have a recession, right? Interest rates are going to go up and inflation goes down. I mean, that's basically the definite, like you don't have a recession and inflation at the same time. It's basically impossible, right? So stagflation is different. It's not a recession, right? It's still growth. There's still growth.
Still growth. It's part of the definition. It's low growth. Yeah.
Right. So, but if you have what happens during a recession is that economic activity declines, right? People stop buying stuff. If they're not buying stuff, there's no price pressure raising prices, right?
Exactly. Yeah.
The other thing happens, you have deflation, which is, or at least stagnation in prices, right? If not outright like deflation, but you actually do, like in a classic recession, that's what happened. Prices went down until people started feeling like, hey, there's bargains to be had, and they started buying again. Right. So I think I just want to unpack it, because I don't want people out there going like, the inflation may cause people to stop buying, and it may cause the Fed to raise rates to stop inflation, which will then cause a recession. But you're not going to have like a recession and inflation not across the board anyway. And maybe there still might be some inflation in some things, right? But so just make sure that like people understand. And the reason I'm saying this is because when you just said like, you stole my line, but cash is an option and opportunity, right? Like, I think the people are like, oh, I can't have cash because inflation is going to eat it up, right?
Exactly,
well,
yeah.
But the thing is, if you're holding, let's just say you stockpile cash now, right? Mm-hmm. Over the next year, you lose 7% of the value of your money to inflation. Mm-hmm. And then there's a recession and prices go down by 20%.
Exactly.
You've just made 13%, right? I don't care about your 7% that you lost to inflation. However, if you invested it because like, oh, cash is trash, I have to invest right now, guess what happened? You just lost 20%, right?
This is so good. People, I don't know what it is. There's just lots of sayings out there that people just take for granted. Folks, I brought it to you over, I think it's been a year ago now. Jamie Dimon had $500 billion on his balance sheet and was growing. And he is perfectly aware that inflation is hot. Yeah. He doesn't care. Warren Buffett has more cash on his balance, maybe not anymore because he spent $5 billion on Occidental. But these guys are not, if it's good enough for them, it's good enough for you. And yes, you could lose 7, 8, 9, 10% in the short term. But if you got a 30% discount later and you only had to use half your cash, leverage ratio is much, much better. So
yeah. I mean, it's like the same people who are willing to buy assets that don't cash flow at all, because they believe they're going to get it all back plus some at the end, right? Because of appreciation, are the same people who were saying like, oh, I can't hold on to cash now because I'm going to lose 7%. And they're not looking at they're refusing to look at the same long-term picture that they just a moment ago told you that you should be looking at, right? Yeah. So if you look at, and I brought up this example again, Seth Klarman, who is this, the guy is this rock star who very few people know about, but the secret to his success is that he's basically 35 to 50% cash all the time. And he generates like 20% annual returns every single year, right? And that's the reason, because he's got the cash. So when somebody comes to him with like a distressed company that he knows is great, he can buy it super cheap. And and Warren Buffett did the same thing. Like that's the key to Buffett's success. And you look at other corporations out there flush with cash, right? And they're not like running out there dumping it into stuff. I mean, obviously there's some people, but the investment community is, because that's how they make money. But if people who are, a little more, people who live on acquisition fees are buying everything they can get their hands on, right? But people who live on returns, are not, right? So
after 20 or 30 years studying consumer, the consumer is very predictable. They rush in at the last minute and then they stop buying at the best time. It's repeatable. So
yeah, the retail investor, right?
Yeah, retail.
Absolutely. I haven't talked about that for a long time, but I used to do a whole presentation about market cycles and market psychology that talks precisely about this issue, about how the market going up eventually sort of pulls in the most reluctant people at the end when they see everybody around them making money. And then that when those people have jumped in, that's kind of when the crash happens.
Time to go.
Well, not only that, because there's no one left to buy.
Yeah, there's nobody left. Yeah,
you pulled in the last fool, and then those will be the first people who will sell, right? Because they'll lose money, and then they'll tell everybody about how they lost money, and the opposite thing happens where everybody starts panicking, and the whole thing unravels. So,
cool.
Yeah.
So the lesson from video number 1 today is cash is not trash. Cash is an opportunity. And you're absolutely right. I stole that phrase from you. You said it and it's stuck in my head. So thank you for that.
I've said it so many times.
Yes, it's in there now. It's my statement. I made it up. No, I'm just kidding. Well, Jonathan, thank you for doing this. Where can people find you?
Yeah. There's a number of ways if you'd like to invest with me. And actually, we have deals going on at the moment. if you're an accredited investor, you can find me at Two Bridges Asset Management LLC. Just Google it. That's the easiest way. Two Bridges Asset Management LLC. Google it and get on my list. You can also join me at my free Facebook community, which is the multifamily investment community on Facebook. And lastly, but not leastly, if you would like to learn how to do investing, you can go to multifamilylaunchpad.org/join and see my offerings there.
Very cool. Thanks, Jonathan.
Yep.